Most people assume the world's most famous burger company amassed its wealth by selling burgers and fries. The math tells a different story. Every day, millions of customers walk through those doors and exchange a few dollars for a fast meal. Multiply that by tens of thousands of locations, and it looks like a straightforward volume business. But running a restaurant is notoriously difficult. Food costs fluctuate, labor expenses climb, and the profit margins on a single burger are razor thin. Mathematically, relying entirely on low-cost food leaves a company highly exposed. It is far too volatile an industry to secure one of the largest corporate fortunes in human history. The actual engine generating the bulk of that wealth sits completely outside the food industry. The company operates a massive, globally distributed commercial real estate portfolio. When an operator opens a new location, they sign two contracts, one to run the restaurant and another to become a tenant to their own parent company. The glowing signs and familiar menus function as a cover, masking a quiet property acquisition strategy happening in plain sight. The primary business of the parent corporation is acquiring and holding dirt. The food is simply the mechanism used to pay for the land. To see how this extraction works, we have to start at an empty lot, long before any kitchen equipment is installed. In a standard franchising agreement, a parent company licenses out its brand name. The individual franchisee is then responsible for finding a location and securing the lease or buying the property themselves. This flowchart illustrates the structural difference in McDonald's approach. Instead of leaving the property to the franchisee, the corporate entity steps in first to purchase or secure long-term leases on prime commercial real estate. To operate the restaurant, the franchisee is required to lease this exact plot of corporate-owned land directly from the parent company, often at a significant premium. This creates a dual income structure. The parent company collects a standard percentage of the store's gross sales as a royalty fee, while simultaneously depositing a substantial fixed rent check every single month. By monopolizing the physical ground beneath the store, the corporation guarantees that, regardless of how many fries are sold, they are the absolute first entity paid. This structure relies on the predictability of commercial rent. While daily food sales are vulnerable to changing consumer tastes or bad weather, rent is a contractual certainty. Look at this graph comparing food sales to rent collection during a local market downturn. While the franchisee's operational profits might plummet, the base rent they owe to the parent company remains a fixed obligation. This mechanic effectively transfers almost all operational risk onto the store owner. The parent company's cash flow remains insulated. Over decades, as cities grow and local property values naturally appreciate, the corporation captures all the underlying real estate equity. They build a massive asset base without managing the day-to-day hiring or cooking at the store. This system acts as a financial shield. It forces the franchisees to absorb the volatility of the restaurant business, leaving the parent company with a cash flow structure that is practically recession-proof. Scale this strategy across the globe, and the numbers become staggering. This company owns or holds long-term leases on thousands of prime commercial lots worldwide. That accumulated physical land represents a real estate portfolio worth tens of billions of dollars, generating predictable monthly income even when overall consumer spending slows down. At the New York Stock Exchange, this model is truly understood. Investors value this company higher than competitors because of its hard assets. Billions in property provides immense leverage, allowing them to borrow at lower rates, fueling expansion. This property portfolio creates a structural barrier. While competitors can update their menus or lower prices, they cannot easily replicate decades of land acquisition at historical prices, leaving them to compete for less profitable locations. Which raises a final question. If the real product is commercial real estate, why invest billions of dollars into marketing burgers? The globally recognized brand is the essential bait. A property is only valuable if the tenant can generate enough cash to pay the rent. The marketing guarantees the foot traffic, and the foot traffic guarantees the rent check. It is a closed loop. The iconic brand acts as the engine driving the consumer volume, while the underlying property extracts the wealth. The next time you see those golden arches, look past the menu. The burgers built the brand, but the real estate built the fortune.